Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, welcome back to another week of the Energy Desk. We are sitting here on October 25th around 1 p.m. Central. And I've got some good topics to discuss with you this week. We've got some stuff in power markets that I think is pretty interesting coming off of the research desk. So where do you want to start?
Well, let's start with, I think there's some interesting numbers in the piece you put out earlier this week regarding, both the peaks and the troughs in power prices as it relates to renewables. So is it just a quick recap on, I guess what is best coined heat maps? Where am I at a peak? Where am I at a trough and why? And I'm sure there'll be some good back and forth there.
Yeah. So this heat maps piece was our last energy shots from this Sunday. And really what we wanted to look at was the wholesale hourly power prices for different ISOs in the US. And what we did, so 2012 to 2023 numbers that we got from government source. And this heat map, we're looking at what is the seasonal distribution of wholesale power prices? When are they cheap? When are they rich? And then from there, kind of dissecting some takeaways. And so really on the high level, some of the interesting things that we're seeing is that seasonality and variable renewable energy is really just your variable generation fuels. So wind and solar are your predominant concerns in that category. What we're seeing in different ISOs is that we have negative power price frequency that is concentrating in months where you have, say, high wind output, which for ERCOT, for example, is in the spring and fall months when you don't have your peak demand seasons. But that high wind output creating a high frequency of negative power prices. And then when wind output falls, it concentrates demand for your base load and your peaker plants and these other generation resources that are a little bit more expensive. And that's when you get your highest frequency of power prices over $150 a megawatt hour. So I think within this category, before I kind of let you dig into the questions, I think it's kind of an interesting look to say, how are the regional ISOs affected by seasonal renewable energy performance? Because it is not the same for each ISO. For example, I just laid out what happens to ERCOT. You have wind output peaking in the spring and the fall. For CAISO, so California ISO, you're looking at solar output being their predominant renewable energy. Their solar is peaking in late spring, early summer, and that's when you have this highest frequency of negative power prices. But interestingly, when you look at CAISO, those negative power prices are concentrating in the middle hours of the day when solar is obviously performing best. And then when solar is not performing best in the winter months, when you have more cloudy weather, that's when you have the most power price frequency, the highest power price frequency of over $150 a megawatt hour. And so, that's a difference from ERCOT. You get into Southwest Power Pool, SPP, and 3 of the seasons of the year, you're looking at the highest frequency of negative power price hours for all ISOs. And then in the summer months, when you have wind speed drop, that's when you have the highest power price frequency for SPP. And this trend kind of repeats over and over. And really the takeaway that I gathered looking at this data is, I guess, twofold. One, it's concentrating the revenue generating periods for traditional energies like a natural gas fired generation unit. It's concentrating those revenue generating opportunities into a much narrower band because they can't compete with negative power prices. The wind and solar can compete because they're subsidized. So that's one takeaway. I think the second takeaway is really just saying, okay, these regional dynamics mean that the risk mitigation, so your risk management, for negative power price exposure, or just your general revenue predictability, that's a different strategy for different regions. And so I think it's a really interesting trend to monitor. And it's one that I think the graphics, for any interested listeners, the graphics that we created for this are really, I thought, quite interesting because you get to see the trends from each year, 2013 to say 2023, and how those seasonal impacts reflect in wholesale power prices. So I'll kind of leave it at that and let you add color.
I think first, just because we're in an industry that so loves its acronyms, and you did a good job of explaining CAL-ISO and SPP, but just unpacking for any listeners, Alex is a treasure trove of data points and is a quick study on putting the pieces together. So back up a little bit, NREL, National Renewable Energy Laboratory, fun with Google if you want to go dig on these things yourselves. And then ISO for those that are more in the traditional oil and gas world. Independent System Operator is ISO. I'll jump there. There's an interesting thing to me on the West Coast in general, but certainly with CAL-ISO. The period you mentioned where you get peak renewable output from things like wind and solar is the late spring, early summer. Well, not included in the typical renewable discussion, strangely enough, it's actually omitted from the data that's called renewable in places like California, Washington, Oregon, is hydro generation. Logically, certainly one that has lived in those areas, such as the fine editor of the Energy Desk, Paige Hewlett, who sits in the background. The hydro output also peaks in that late spring, early summer timeframe. So on the West Coast, it's part of that peak to trough is because I've got all the snow melting running off the side of a mountain through a dam. And yes, the probability of us building another dam is near zero. Plenty of environmental activists that will ensure that never occurs, and with good reason, honestly. The solar and wind piece, I think, is also interesting. I know we'll get to this, or we may get to this a little later. There's also the challenge with where to site it. And so the pricing itself, the peak to trough, also comes with some interesting challenges in transmitting that power from where it's produced to where it's consumed. And, logically, the bigger the metro area, the more it could benefit. And at the same time, until we set about to put a solar panel on every flat roof, think all of your giant warehouses, what if Costco was covered up in solar panels? Will you begin to see enough scale from renewables to really be able to flatten out the curves you're talking about? I think you hit on a really important point there about managing risk. It's a interesting challenge if you were to try to sell forward your power production, or if you were the purchaser. Am I stomaching a significant loss at certain times of the year, whichever side of the coin you're on, just to mitigate this short period of time? Or conversely, am I willing to pay and or buy this, short duration, call it, December through February or July through September, pick your ISO. And then the other thing I think is also important in the discussion, probably worthy of a segment in a future energy desk on its own, is what is the energy mix in each of these ISOs? Is it weighted to gas? Is it weighted to coal? Is there still enough nuclear laying around to make a difference? In some ways, the higher the nuclear quotient is in an ISO, the deeper those negatives can be. You don't dial a nuke back the way that you would dial a combined cycle back or even a coal plant. And they kind of work in that order: gas, coal, nuclear. And, not that it's out of the question. In fact, in the Pacific Northwest in 2012, when gas prices were abysmal levels, or at least at the time what was thought as bad as it can be, we've certainly found new lows since, there were nukes that would cycle down over a weekend. So it's I think in conclusion, or in transition to the next tangential topic in the world of power and renewable energy, is that the flexibility, how creative, how dynamic can we be? It puts a lot of pressure on grid operators. And, in some ways, I guess there's a tie to some of our past discussions around AI. It's hard to imagine that the human brain can move fast enough and pull levers, punch keys, whatever it is that makes all the magic happen when you flip your light switch with such incredibly swift changes from too much to too little power.
Yeah. The interesting point that you mentioned on the cycling side is, what does the variable renewable energy, which I'm from here on out just going to say VRE, what does that market share do to, as we've talked about in the past, the net load curve? And, in California, ISO, CAISO, we've looked at the duck curves that have become increasingly pronounced, but really the portion of the duck curve, which is the end of peak solar output to peak load window. So basically you're looking at 3 p.m. to 8 p.m. And I think that is really an interesting question for the cycling stress for gas-fired generators. And then also kind of transitioning to this next portion is how does the battery energy storage system, which I'm going to refer to as BESS, so BESS, how does that affect this kind of problem that grid operators are really highlighting from how do we manage this really rapid change in supply and demand? And, one of the interesting takeaways staying on this one heat map discussion was that when we look at California ISO, who has the highest power storage in US ISOs, versus PJM, who has the lowest power storage in the US, we're seeing kind of an interesting difference in these trends where from 2019 to 2023, you have pretty robust growth in California's power storage capacity. But over that same period, you also had an increasing share or increasing frequency rather of negative power price hours and power price hours over $150. So you have more volatility despite having this system that is intended to mitigate the volatility in variable renewable energies. And conversely, when you're looking at PJM, they're relatively stable. They have very low power storage. So I think that's an interesting question to kind of keep asking, keep looking at, because it's not really clear. You kind of have a clear conclusion because there's so many other confounding variables. But kind of transitioning into this power storage discussion, one of the interesting things from this week that we wrote a little piece about was Tesla. So Tesla's Q3 earnings recap, they provided a really, a nice headline EV forecast for their investors, which had a really positive impact on their performance since that earnings call. But one of the more disregarded points of their Q3 recap was their discussion on storage deployments. And so when we look at Tesla, you have the EV business, but as kind of discussed with Rishi on a previous episode of the Energy Desk, that EV business has a lot of synergies with Tesla Energy, which is a subsidiary. And Tesla Energy is producing both residential scale, so just a battery for a home, you have a solar setup on your roof, you get to power your battery when sun is shining, etc. But they also have a utility scale power storage system that they call Megapack. And the Megapack has increased in capacity in recent years. So the latest one is about 1.9 megawatts power for 3.9-ish megawatt hours of energy. And the really interesting thing to look at for those numbers was that Tesla's global power storage deployments, so it includes the residential and utility, they don't segment those, but total reached 20,400 megawatt hours in the first 3 quarters of 2024. When we compare that to the latest data, which was released yesterday from the EIA for grid scale battery deployments in the US, we have, roughly 19,000 megawatt hours. So Tesla has 5% more storage deployments than is connected to the US grid. So that's just kind of a contextual number.
I've got a question on that one. Does the EIA data, would it include any of the Tesla storage, or yes, would it be?
Yes. So it is overlapping.
Okay.
But I think it's more of a contextual to say, how much Tesla's power storage adoption has grown. Yeah, their market share exactly. And it's really, I think, highlighting those synergies between their EV business and this Tesla energy business, because while the battery technology itself is not directly one-to-one transferable, they do rely on each other quite a bit. And I think that the growth rate is really a notable number to highlight too. So Tesla's power storage deployments have grown at an average annualized rate. So quarter Q3 2024 over Q3 2023, et cetera, going back to 2019. That has had an average annualized growth rate of about 97%. And so really just kind of a booming adoption. And to the point of Elon Musk's commentary in that earnings call, he said the hottest Tesla product probably will be the battery. And I think that really kind of gets back to this variable renewable energy conversation where you have a installation queue totally dominated by VREs. I was just doing the numbers on that, and 86% of the generation capacity that's going to be added to the US grid between 2024, so October 2024 and the end of 2030, 86% of that is going to be either solar, batteries, or onshore, offshore wind. And you have a lot of those non-battery generators. Those are going to need some kind of backup system to manage that volatility, or have a battery that's going to let these generators participate in energy arbitrage opportunities. So charging the battery when you have near zero or below zero power prices, and then discharging that power when you have your peak demand between, say, 5 and 8 p.m. for higher power price.
It's a really interesting dynamic, what you just shared in terms of the number of generation additions and the number of them that are VREs, and then, including batteries in that. And you mentioned something earlier that I think is critical to make the point. That likely would not be the case without subsidies. And for the better part of a decade now, there's been a discussion around weaning off of subsidies. So it's a kind of a fascinating sociology experiment, if you will. As long as the drumbeat is kept up of climate change, then the subsidies will likely stay. So it's kind of a self-fulfilling. You need that narrative to stay just as strong as it's been, if not become stronger. The number of tax dollars, whether you like renewables or not, you are paying for them. The subsidies are free flowing still into that industry, and thus the private dollars logically would keep chasing it. And there's another interesting point there, like you mentioned, the ability to participate in energy arbitrage opportunities. What an industry. You can get paid to add something, and then you're still allowed to extract the margin in that arbitrage, and you don't have to share it. I mean, it's a remarkable freight train. I mean, it left the station, I'll call it 2008-9, and it has gained momentum since, and it's showing no signs of slowing. Hey, I got a question for you with the Tesla quarterly call. Did they mention places in the world where they were seeing higher adoption?
Yeah, so they didn't mention it in the call, but I did some background research just to kind of see what was what. And currently, most of these Megapack batteries are produced in their Lathrop, California plant. They have a new Megapack factory coming online in Shanghai that I think will kind of help them capture some of that Southeast Asia or just general Asia market, because a lot of their interest was either in the US or, from what I saw, really concentrating in Australia. And so some of their biggest projects have been in Australia. Kind of makes sense. I'd be curious to really dig into their supply chain, because Australia is increasingly becoming kind of the G7 backstop for secure lithium and critical mineral resources. And that's really where investment dollars in Australia are going as well. So it'd be really interesting to dig into that, because I suspect a pretty close partnership between, say, somebody like Tesla and Australian mineral producers. But I think that, to your point on the interesting market dynamics, it's a little bit of an interesting problem to think about, where you're saying, okay, we're having a generation resource that's increasing market volatility, and then having other opportunities stem from that, like energy arbitrage, that are both subsidized. And so I guess when I was doing this research, I was really thinking it'd be interesting to get your thoughts on how, one, that seasonality is currently affecting U.S., say, natural gas markets, traditional generators, and follow on to that, how will and we should actually get back to this cost of the battery, but how will these battery deployments maybe start to adjust what's going on in natural gas markets and the seasonality with high power prices, low power prices, negative power prices?
Yeah, honestly, I think that train left the station about 3 or 4 years ago, and it also has gained momentum since. And for evidence of the correlation between power prices, and by the way, power prices and gas prices will continue to be for likely now until forevermore, or at least until Elon Musk manages to get a battery in every home and every business around the world. They will remain highly correlated. So how is it affecting seasonality? I think you see it most in basis markets across North America. The, peak to trough travel in basis markets is not a new dynamic. Those that are in the natural gas market have seen that evolve rapidly over the past few years. And if anything, with a couple mild winters in a row, and thus ample gas and storage to begin the summer season, maybe we have yet to see what is to come. We really haven't had a significantly cold winter in the U.S. since 2013-14. And so it is certainly having an impact. I think what becomes more evident is, and I'll take a drill down to a very micro example of how this VRE behavior impacts the natural gas market. So on October 1st, one of the newest pieces of natural gas infrastructure that the market's been waiting for came online, that being the Matterhorn pipeline, taking Permian MMBTUs and delivering them into coastal markets, namely the Houston Ship Channel market. And the idea for many months has been that there will be too much Permian supply on the Gulf Coast, and it will really hammer the Houston Ship Channel market. There's just too much gas waiting on a way out. Well, from October 1st through about October 9th or 10th, I'd have to go back and check the day, the Houston Ship Channel market said, thank you very much. I will take all of your additional Permian MMBTUs. And in fact, I will trade at a tighter relationship to Henry Hub than I had in the 10 to 15 days prior. So how is that? Why is that? Well, back to what Alex mentioned before, the ERCOT or the Texas ISO, and most, it's essentially the whole state. There's a few little pockets that are not ERCOT. It experienced very low wind generation over that period. And actually, there are a few days in the tail of it, the Houston Ship Channel market traded flat, and I believe even slightly over the hub, with wind generation and ERCOT down at extremely low levels. You could say there is some interconnectivity. The collective of ERCOT, MISO, or the Midwest Independent System Operator, and SPP, who are actually one and the same now. The collective output from those three, who generate the vast majority of U.S. wind generation, say 70% or so, 60%, 70%, fell to 20 gigawatts. And then just a few days later, and fittingly, over a weekend when demand typically is lower anyway, wind generation spiked up to 60 gigawatts from those collective three ISOs. And lo and behold, Houston Ship Channel prices dipped down to 50 cents under Henry Hub for day-ahead gas, or in that case, for the weekend, the Friday, Saturday, Sunday package. And many were banging the drum. See, it's too much gas coming from West Texas, when it was readily apparent for anybody willing to look at that relationship between gas and power markets to see that wind goes up, power prices go down. There is no need for gas generation, which means there are extra MMBTUs. But the Permian and the Matterhorn pipeline did not create them. Mother Nature did. And, I think the southeastern U.S. is often overlooked. It's seen some of the fastest growth in VRE adoption. Now it's back to one of those, like, the smaller the denominator is, the easier it is to show prolific growth. Go back and look at Texas 2010, 2011. However, I think that this is coming to all markets, and, plenty already have. I think when Alex was discussing the, Western U.S., the adoption rate for renewables out there really only lag Texas, strangely enough, one of the most prolific hydrocarbon producing states. And yet also until I'd say the last 5 years was the fastest growing renewable market. I guess we just like all things energy in Texas. So the volatility is not going away. There's more to come. It will be day to day, week to week, month to month, season to season, until there is critical mass on battery storage. And I'm just going to say that, just throw some broad numbers out here. If total U.S. generation averages around 470 gigawatts, if it's 470 gigawatt hours, then you've got, battery storage at a small fraction of that. 20. Yeah. Once it gets up to 20 or 30%, maybe there are annual impacts. So the severity of the impacts is here now. We'll likely only get wider bands and test, all of these ISOs, they've all got different monikers for it, but the price they're willing to pay or the cap they're willing to set, there's some cap that says, okay, well, you have to turn things off. Or there's some, like in PJM's case, you essentially pay generators something to be on standby all the time, whether you're running or not. It is entrenched, not going anywhere.
Yeah. And
with that, I want to go back to something just so we don't lose it. You mentioned earlier getting back to the cost of these batteries. Let's jump back real quick to what Tesla has shown in the way of cost reduction in deploying these.
And this is perfect. So it kind of gets to my next question too. So when we were kind of breaking down all of this Tesla energy storage deployments, also looking at what's happened to their cost for a megapack unit over the last, say, 3 years. And in 2022, and these fluctuated, so this is an approximate number, but in 2022, Tesla's 3.9 megawatt hour megapack unit was roughly $1,144 per kilowatt. And so that's, for context, a new natural gas combined cycle unit, according to EIA numbers, is roughly $800 per kilowatt of capacity. So in 2024, the synergies that I mentioned before between their EV business and this Tesla energy business and their kind of integrated supply chain has brought that cost down to approximately $543 per kilowatt. And so on one hand, when you're looking at how are these batteries currently being used, a lot of the push now is saying, okay, we're not going to develop any new solar capacity if it doesn't have the battery capacity alongside it. So just kind of a combined system like that, what's the cost? You're saying in 2022 for solar plus battery, looking at about $2,400 per kilowatt. That's down to current numbers, roughly $1,900 a kilowatt. And so still considerably higher than the equivalent capacity from something like a combined cycle gas generator. However, I do think that battery cost is steadily, not even steadily, it's coming down pretty quickly as they get a little bit more integrated. I think there's still a lot of risk to that because none of that supply chain is actually owned within the US like our MMBTUs from gas. So you're relying on potentially unfriendly trade routes or the nations that you source the critical minerals from. However, kind of the question that I have about this is, is there any indication of an opportunity that you see for batteries to not just be a solution for variable renewable energies, but also for the broader generation mix within the US to say, okay, how do we match up our supply and demand and reduce some of this volatility and also reduce the stress on our combined cycle units when they're, or whatever unit is having to fire up and fire down in those peak hours?
The battery, really shouldn't care what kind of power it's able to store. If gas prices are cheap and that is part of the driver of low power prices, then great, store away. I think batteries are a really interesting idea with, to me, just a couple of key questions. One you touched on, are we sure we're going to be able to get all the lithium or whatever rare earth mineral it is we need to make this thing? I'm sure those technologies will change and evolve. And then what do we do with them when they're expired, if you will? We kind of conveniently forgot all about Yucca Mountain and how do I store spent nuclear fuel rods as we started retiring nuclear fired power plants. And I guess maybe that's going to change again. But I still have this, I haven't found a suitable answer to what happens to all these batteries. Is that going to be, 50 years from now, several generations? And, our kids are, instead of talking about microplastics floating around the ocean, are they talking about giant battery waste dumps that are setting the ground on fire?
Yeah.
I'm not really clear. I think it's a great idea. I think the other thing to me that really stands out in what you shared there is the cost reductions. Logically, as a taxpayer, as someone that personally feels that we should just be as efficient as we could be in all areas, if the cost reduction gets down anywhere near parity with a traditional energy source, please, powers that be, erase the subsidies. That essentially has the pendulum swinging too far. As humans, we love to do that. And you'll probably just kind of keep on going with the subsidies. And then we'll have so many variable renewable energy sources and so many batteries, and we won't know what to do with the batteries, and we won't know what to do with the volatility. And we'll go, wait, where's the gas? Where's the coal? Oh, right. We put them to bed with our subsidies. So some sanity around, looking at the full spectrum. All of these are fine sources of energy, and let's comprehensively plan for the utilization of them. And some would say, well, yeah, capitalism doesn't allow for that. It chases the dollars. And while I can agree, subsidies do not equal capitalism.
It's not a true market. And I think one of the interesting takeaways from the Tesla earnings call also was that point was acknowledged by Elon on the call, where he noted that the 2-hour discharge for these mega pack systems, you can get up to 4 hours. Even with 4 hours, you're not able to cover the worst minute of the worst hour of the worst day of the year, when all of your other generation resources, your variable renewable energies, are having their worst day. What's going to be your generating backstop? Where are you going to get your power? And to his point, you have to plan for that. And that's not really captured in the current market mechanisms. I think I gather a little bit of a trend that's going to reconcile that, because you have this expected, if it comes to fruition, you have this near-term expected load growth that we haven't seen for the past 2 decades in the US. It's been flat. Now we're not flat. You want to go to something like a nuclear. Great. Nuclear takes 10 years just to get through regulatory approval. You have batteries. You can't rely on batteries after 4 hours. So there's a lot of these movements that are there. But I think the understanding of each resource's limitations is steadily permeating through other markets. And I think that while people might not want to acknowledge that in their PR setups, I think that is a reality that people are starting to appreciate. We just saw some other pieces where Mitsubishi, manufacturer of gas turbines for generation, they're having their best demand yet. So I think they said that they have like 60 gigawatts of orders for their gas turbines. And so I think that is just kind of this subtle trend that's passing under the radar. But, I think I don't want to bet against any of these emerging technologies, because I think, as we probably both agree, abundant energy and cheap energy, reliable energy is really the goal. So I think just having more of that balance is hopefully where it heads.
Yeah, certainly. I think we could probably stay on this topic for quite a while. Let's maybe move back to some traditional energy markets, and what has been a rather benign period for oil. And maybe we'll just both kick ideas back and forth on this next one. So I will open Pandora's box. A week from Tuesday, we'll have a U.S. presidential election, and there are plenty of opinions floating out there on what happens depending upon which U.S. presidential candidate is declared the winner, while admittedly looking back over the past several cycles and going, well, whoever's declared the winner, there's probably something to come after that too. I don't know. What's your take? What do you think people are expecting in the way of market behavior in a Trump presidency? We'll start with him and then we'll go to Ms. Harris.
So I think a lot of the stuff that I've been watching for the election has actually been on, I would say, related markets that have maybe downstream impacts on energies. So really looking at how are yields and some of these other like sovereign debt markets, how are they performing? Very interesting stuff there, but we'll save that for another time. I think the commentary around a President Trump re-election tends to look at the supply growth that would potentially come from that. I, at face value, tend to discount how much change could happen in a short period there that would, materially impact, say, the cost of energy, even just within the U.S., where in crude markets, you're really it's a global dialogue between the U.S., OPEC, and now emerging non-OPEC production, and how much of that is within the control of the president. I think that there's pretty limited control that any president can really have, as we've kind of discussed on the sidelines before. I do suspect that the regulatory environment will see some pretty notable shifts, specifically looking at some of the EPA regulations with Chevron deference. So for listeners, Chevron deference just went through the Supreme Court this summer. The Supreme Court ruled to overturn Chevron deference, which was a 40-year precedent that really enabled some forms of executive overreach. So you really want to have your legislative, judicial, and executive branch operating within the parameters designed by the Constitution and other documents. And so what happened since 1984 was that this precedent enabled administrative heads appointed by the executive branch. It gave them power to pass rules and regulations that did not go through Congress, their intended route to get through. And you have a lot of indications recently with the EPA kind of with, say, EV mandates, or what they pass through as the emission standards that would require a certain level of EVs, as one example. Another one is the carbon capture and sequestration on gas-fired, coal-fired generation. CCS is an unproven technology at commercial scale. So there's a lot of these things that are passed through that I think will face a little bit of trouble. I think it's interesting to see some of these recent Supreme Court rulings that are not totally against the EPA. So I suspect, though, that with a Trump administration, that probably gain some tailwinds, removing some of those regulations. I don't know. What do you add to that? Or
yeah, I think I concur. We could be succinct on something for once. No, I agree with all that. The only thing I'll add to it is that what you touched on is often coined drill, baby drill under a Trump administration. I think what will come first and have the ability to have a more immediate impact, you very appropriately pointed out, whatever decisions are made in terms of direct impacts in the energy world will be rather slow. Price is going to have to dictate, unless we start subsidizing oil and gas drilling. Boy, wouldn't that get Greenpeace excited. Take that wind generation, highly unlikely, meaning 0.00001% chance. But what will be front and center with a Trump presidency, I think almost immediately, is what are the optics around the relationship with bin Salman and the Saudis and OPEC at large? Clearly there's this still in the background looming, member of OPEC, but doesn't actually really play with OPEC's rules, Iran. I think the immediate focus will be on, is there going to be renewed sanctions on Iran and Venezuela in a Trump presidency? What would that do to production in those two countries? And just for some context, if you go back and you look at peak sanction levels, how much production will we lose versus today? It's about 1.7 million barrels. You have to take out the 2020 lows because that was a different thing. That was a further low driven by price. Everywhere went down. That whether you were sanctioned or not, you cut production. You were saving it for a later date. So you would lose about 1.7. How much could the Saudis bring online? 2. So relatively neutral. If anything, we've got an extra 300,000 barrels a day. But then, like, the other interesting little nugget to me with a potential Trump presidency is along the lines of the drill baby drill idea. Logically, you would want to export more, or at least the ability to export more U.S. barrels, gallons, MMBTUs, on and on and on. And in order to do that, you can't be in this, just outright battle with the Saudis and OPEC. So is there some behind closed doors discussions that say, hey, you take some of the market share. We won't go too fast. Let you get these great global prices while we quietly over here are opening up our pathway to get more of our BTUs of all form out into the global markets. And, the big losers in that, who would that be? Europe and China. So there will be some grumbling for sure. All right. So we kind of just stay on that one candidate for a while, but in order to stay relatively brief, let's go to Ms. Harris. What's your high level thoughts on a Harris presidency? How does it correlate to changes in energy markets?
This one's, I think, a little bit more difficult to eke out a clear answer. I think one of the clearest takeaways I can offer is maybe that the regulatory side would not change as much. It'd probably be a continuation of the Biden administration in most aspects for energy regulation and energy policy. I think that we see a lot of those impacts, as we just discussed at length, passing through to the power market side. So variable renewable energies and investment tax credits for each of these resources in legislation like the Inflation Reduction Act. I think that continues. Outside of that, I suspect kind of a limited investment appetite for infrastructure would be kind of the additional side of that I would tack on. But, that one is one that I'm monitoring more closely, but still do not have a clear takeaway.
I agreed. It's a less clear message in general. Her words directly when you listen to interviews or even debates. I think even media outlets that would typically be in strong support of a Democratic candidate have begun to question the indirect responses to very direct questions. So thus, it's kind of hard to I don't know exactly what happens here. I'll say that maybe someone else has written it. Giving myself a little pat on the back here. We wrote earlier in the week in comparing the two, the drill baby drill candidate and the spend baby spend. So in general, I may be unfairly painting Ms. Harris with a broader Democratic brush of, we'll spend it. Somebody else will have to figure out how to pay for it later. I think they're actually, I think the idea is that if she were and that party were to, have kind of some sweeping power in the executive branch and through Congress, that it would be a negative for demand. I would imagine that immediately there would be more spending than people expect. It's not necessarily a traditional path for that party. However, we've had a rather stagnant environment here for the better part of the recent presidency. And so I think there would be more spending than people expect. And then I think in respect to the topic brought up earlier, OPEC versus U.S. president or Saudi with U.S. president, however you want to frame it, I don't see a path where there is a functional working relationship. However, there also is not likely to be much pressure placed on Iran at all. Venezuela, a little bit more of a coin flip. And I think the other really interesting nuance in there, and almost moved on without mentioning this, I believe Harris herself, somebody should go fact check this one on me, but I believe Harris herself and certainly the party has long lobbied for changes in the Supreme Court. So as you mentioned, the Chevron deference case was reversed. But what if you just go through and completely change the dynamics in the Supreme Court? Do we now just make that another political entity that all of a sudden, maybe not the blanket policy, and yes, I'm calling it policy because it seemed more policy than law, gets woven back in with a far different Supreme Court dynamic than what we've known for a very, very long time now.
Yeah, it's an interesting time. And I think, as you wrote in some of the daily market updates this week, another component for markets to pay attention to is the role of low spec interest in contracts like WTI.
I think it makes perfect sense. You've got just the, WTI itself. So there's plenty more to glean from open interest in products, or certainly in Brent, a bigger global market. But WTI open interest, so longs plus shorts, just for quick reference point for those that aren't familiar with the CFTC, or the Commodities Futures Trading Commission Commitment of Traders report issued each Friday for the prior Tuesday. The, positions are reported as longs or shorts. You don't know where on the curve they are, but you do get to see the number of contracts or the number of barrels. And both longs and shorts have moved to the sidelines, which honestly, were I in that position, I think that would be a prudent step. It's hard to say exactly what happens next. So don't get caught in what can be a fine example of markets can stay irrational longer than you can stay solvent. So I think that is a really interesting maybe topic to kind of end on today. And, thoughts on the oil market. So does it make sense fundamentally to go down and trade $55 a barrel anytime soon? Absolutely not. Supply will contract. Does it make sense to go to $85 a barrel anytime soon? Well, not during CapEx season. You don't need more U.S. production. It's not clear that we even need more global production, but to expedite any return of OPEC barrels, to have U.S. producers try to hurry up and grow into an export wall, there's a topic for another time. Neither makes sense. However, cannot be ruled out when spec and open interest is this low. And, for context there, we're, about equidistant. Tried to cherry pick a couple points. We're around $70 at the front of the curve. So 55 and 85, meant to be somewhat uniform. But, I think in the next couple of months, and I'll say maybe even through inauguration, all bets are off. So it'll be interesting to see how spec positioning gets reported each week. And if there is anybody willing to dip their toe back into what feels like a dangerous time.
Yeah, very, very dangerous time. A lot of variables at play. So we'll leave it at that. And as mentioned at the very beginning, some of those graphics that might be interesting for listeners to take a look at. We'll throw all that in the show notes, and I'll see you again next week.
Good talking with you, Alex. Thank you.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.